Hi everyone, welcome to another series on how to enhance portfolio returns. Today I'll introduce the concept of cash secured puts, which you can use to accumulate shares over the long term for a better rate of return. Long-term investors typically pick undervalued companies after studying their fundamentals and accumulate them over a period of time. However, a huge part of that game involves waiting for these shares to fall to their ideal prices. You could be bullish on the stock over the longer term, but believe that there could still be some downside in the short term. What if I told you that you could generate returns while waiting for prices to fall to the ideal price you have in mind? Using the cash secured put strategy, you will be able to earn option premiums while waiting for that to happen. So without further delay, let's go into how do we trade cash secured puts. So firstly, traders would need to sell an out-of-the-money option at their desired strike price, ideally below where the market is trading at, and of course pick an expiry date for the option. If the stock moves below the strike price by expiry, you will have to buy the shares at the strike price. However, if the stock stays above the strike price, you get to keep the premiums with no additional obligations. What are some of the potential benefits of this strategy? Firstly, it boosts your total returns from investment. If the stock falls below the strike price on expiry, then you get to own the stock at the price you were comfortable buying at in the first place, plus an option premium on top of it. If the stock stays above the strike price on expiry, then you get to keep the premium for no additional obligation. Secondly, you get to churn premiums repeatedly. The most attractive part of this strategy is if the option expires with the stock price marginally above the strike price, then it gives you a chance to sell the put option again at the same strike to earn a similar premium. So how about some of the potential risks? First of all, there could be a loss in potential profits. So if you didn't sell the put option, you might have bought the stock at the current trading price. If the stock rockets higher instead of falling to your desired strike price, you might experience a loss in potential profits. However, if you had intended to buy the stock way below the current market trading price, then this will not affect you. Secondly, path dependency risk. So there will be scenarios where the stock falls below your strike price before expiry and moves back above your strike price by expiry. So in this scenario, you will not be assigned shares at the strike price, and therefore you might miss out on the eventual upside of the stock. If you didn't have the option, you might have already bought the stock during the dip. Thirdly, delivery risks. So the buyer of the option can exercise the option at any time during the tenure of the option because equity options are American style. So it is important to have adequate cash to take delivery of the stock at all times during the tenure of the option and not just at expiry. So with all the risks covered, let us try an example together. So let's say you're intending to buy 100 shares of stock A at the price of $100. The current trading price of stock A is slightly higher at $110. There are a few ways you could do this. You can place a buy limit order at $100 for 100 shares of stock A and wait for the stock to fall to that price. And this is what most of us are doing or intend to do if we wish to buy a stock at a price below the market. However, the second option is by selling an out-of-the-money put option on stock A at a strike of $100 for 1 month expiry. So you receive some premium, okay, say $500 while waiting for stock A to move below $100. So there are two scenarios that can happen after this. First of all, if stock A closes below $100 on expiry day, you will be assigned 100 shares of stock A at $100, where you will need to spend about $10,000 to buy the shares. You would also have earned the $500 premium on top of that, so it reduces your cost of acquiring the shares. The second scenario is that if the stock does not close below $100 on an expiry day, then you will have no obligations at all, and the option will simply expire worthless. However, you have to remember that you have earned the $500 option premium when you sold the option initially. So that is for yours to keep. So let us go through some of the best practices in using this strategy. So typically the best traders and investors, they don't go all in while using this strategy, right? If a trader wishes to buy 1,000 shares of a stock, they might buy it in a couple of tranches, right? Say $200 shares every time the stock moves 5% lower, as shown in this diagram over here. They can also mix and match, by combining the buying of shares with selling of the money put options. So this way, they can build an exposure over various prices and at the same time earn premiums while doing so. So just like the example shown in this article, an investor can buy 100 shares of the stock at the current price and sell one put option at various strike prices below the current price to accumulate their position over time. So the key takeaway here is that there are many ways traders can use put options to accumulate shares. Some traders might choose to sell put options at different strikes at one go, right? Some might choose to sell put options at one strike first and then wait for the stock to move lower before selling the next tranche. Both methods have its pros and cons, right? So selling put options in tranches as the stock moves lower, would yield better premiums. However, if the stock continues to climb higher instead, then you might get even lower premiums than before. As an investor, the most critical part of this strategy is to think about the overall exposure you wish to have, right? And make a detailed plan on how you wish to get there. Every investor has different goals and different risk appetite, but I hope you will be able to find the best way to utilize this cash secured put strategy. With that, that's all. So please click on the link below to access the article, and I wish you all the best trading the markets. Thank you.